In high seas or calm, both opportunity and risk lurk just below the surface. Answers require in-depth analysis. Welcome to BlackFin Group's Shark Cage podcast, where experts dip below the surface of important industry issues in search of hidden opportunities.
Good day, folks, and welcome to the Shark Cage BlackFin's podcast series. My name is Keith Kemp, President and CEO of BlackFin. I will be your host today. To start, I want to thank our sponsors. A special shout out to all of BlackFin's preferred partners: MortgageFlex, Constellation Mortgage Solutions, Flowify, Cloud Virga, LendingPad, IE Merchant, our newest Prudent AI, and many, many more preferred partners, all just doing absolutely great things for the mortgage industry. Okay, so before we get started here, folks, I'm pretty jazzed up about the folks we have in the Shark Cage today. Today, we have our preferred partner, the leadership team at MortgageFlex. And before we jump in, I really want to take a couple minutes to properly introduce the executive team that's with us today. And might I say, folks, I think by understanding their incredible backgrounds, it will really help provide you the keys to really understanding where they've been and where they're at now and where they're going as an industry leader with their particular offerings at MortgageFlex. I think you're going to really be intrigued to hear their perspective as it relates to all sides of mortgage technology. So to start, let me mention a little bit about my good friend, John McCrae, Senior Vice President of Business Development. He joined MortgageFlex in 2004. John literally has over 25 years of sales experience in the financials and software industries. He's played critical roles in sales at First American and prior to that with Harlan Financial Solutions, where he was also responsible for training implementation plans for new clients and managing assets for large sales efforts. Wherever he's gone, John has been recognized and won countless awards for his commitment to client success. John served on the chairman of the Massachusetts Mortgage Bankers Association Technology Board. Thank you for your service, John, as well as the board of directors for the MMBA. So obviously, amazing perspective there that helps contribute to his continued success today with MortgageFlex. We also have on the phone with us Craig Bechtel, the Chief Operating Officer at MortgageFlex. He's responsible overseeing daily operations and management, strategic product and business development efforts. Craig joined MortgageFlex in 1999 as Vice President of Product Development and of the LoanQuest product line. But prior to MortgageFlex, Craig has held Director and Vice President positions at Fiserv and PNC. His experience in the financial services industry spans software development, testing, training, project management, sales, implementation, all those moving parts. Craig is very active in the Mortgage Bankers Association and with Freddie Mac. He served on the MBA's retail origination and cultural diversity committees. Thank you for your service there, Craig. He is currently a member of the MBA Technology Forum and Freddie Mac Vendor Advisory Technology Board. He's been published in all the leading mortgage industry publications and actively engaged in national mortgage conference panels and other key industry forums. Craig is a seasoned technology executive, I think goes without saying. Last but not least, I'm really excited to introduce Lester Dominic, who is also joining us today. He's the founder and the owner of MortgageFlex. In 1980, while working as a consultant at Arthur Young and Company, now Ernst & Young, that's why I kind of get that bumbled, but he identified the need for information technology consulting services specifically for mortgage lending. Lester then founded MortgageFlex Systems and focused solely on the mortgage lending industry, introducing the first microcomputer-based loan origination system in 1984. Recognized in 2008 as an industry pioneer by Mortgage Banking Magazine and is widely acknowledged as an industry expert. MortgageFlex really continues to receive top industry accolades for the thought leadership that he brings. Lester has led the company's efforts to provide its customers with robust systems using the latest technology. Lester is heavily involved in daily operations at MortgageFlex and the industry with his management team and the developers. Continues to lead the company as CEO and Chief Product Architect. So, gentlemen, I'm just really excited to have you here. I know that was long-winded, but man, your backgrounds are absolutely impressive and underscore really your thought leadership. So thanks for joining me today.
Absolutely.
Thanks for having us, Keith.
Absolutely. So I'm going to go ahead and just jump in here, guys. I don't want to do all the talking. I know that was a long-winded opening, but man, again, I think it gives people some perspective. And I honestly, even all the years I've been in the business, I really hadn't gotten to know you guys until over the last 3-4 years. And it really has been impressive to see what you've done and how you've led the industry over time. But I'm going to start the question by saying, so when really considering that for over 39 years, MortgageFlex has been leading various technology revolutions in the mortgage space. How would you describe the mortgage technology space today? I mean, let me just give you a little more color on my question here, but I mean, literally zero new technology advancements in the servicing side. We can all vouch for that. But then on the origination side, they're being pummeled with new CRMs, point of sales, marketing systems, LOSs, and LOS light solutions. So how could someone new to the industry possibly make sense of it all? We get those calls on the consulting side, people asking for help with their technology strategy. But you all three have very unique perspectives on the mortgage space, the mortgage technology space today. So based on your backgrounds, John on the sales side, Craig on the dev and delivery side, and the vision for where the industry needs to go, Lester, what say you? John, let's start with you. How would you describe the mortgage technology space today?
Thanks, Keith. Yeah, I would agree that the majority of the technology investment that we see is still going into the LOS side. And we see a few new companies popping up as a result of that. On the servicing side, as you alluded to, it's pretty much status quo, except for the disruption and investment that we feel that we're bringing to the space. Last week at the Acumen conference, had a lot of interest from servicers that, and I see that true across the entire lending space. And they're looking for somebody to innovate, and we're confident that we have the right solution for them.
That's good. Good point. Craig, your perspective?
Well, we've been doing this a long time. I mean, a seriously long time. Since '99, there have been more revelations have occurred in that time than we can keep track of. Lester and I were talking the other day about AI. And AI is the latest, newest thing that now everybody's trying to jump on the AI bandwagon. The reality is that we've all been using as some flavor, some depth of AI for many, many years now. I mean, we've been using DU. Industry, we support DU, we support LP. I mean, Countrywide had their engine many. So AI has been out there. So, but really, you talk about what has made significant changes, and so, as you pointed out here, there's on the origination side, everybody's got a new idea every 6 months or so, and the problem with so many of them is that they're all isolated into silos, and they're only dealing with one short little aspect, and they don't necessarily integrate really well. Back in the day when I was at Sears, we used Lomas and Eldon, servicing platform, origination platform, and then a secondary marketing platform. And these were all platforms, all from the same company, that supplied all the major components in the lending space. Now, loan officers were still taking paper apps. They're faxing them into to a crew of people who sat and keystroked them into 3270 terminals. But we all had integration code that talked, and this is all from the same provider. Integration code that talked from the front end to the secondary marketing side to the servicing side, and it was less than adequate. There was gaps all over the place. And then if one of those components went down, your whole operation kind of froze up until somebody figured out what was wrong with the integration code.
Mm.
We're still dealing with integration code issues. Look at all the point of sales out there. I mean, and this was back in like 2000. So this is 23 years ago that we had integration code problems back then. I mean, we had other issues as well. We had a guy walk into the room once and tripped over one of the power cords and shut down an entire integration component, and we couldn't figure it out because it was unplugged. But that being said, we still haven't improved upon that.
Wow.
We're trying to make improvements on it, but you still have to implore people that, how many over the past 5 years, how many new point of sales have come out? How many new point of sales have come out and gone away?
Yeah.
And so you're still not, we're trying to address what we feel is one of the core components, which is data. And consistency of data across all the different platforms, and whether you're a loan officer in the field, whether you're in servicing, whether you're in secondary marketing, whether you're processing, closing, whether you're integration to doc providers or quality QC providers, the data is all the same, and it's all coming from the same places. And you're not having to rely on integration code. That, frankly, is the big problem why you have all these point of sale show up and go away, because they're all trying to integrate, and integration is not exactly great.
So let me summarize part of what I'm hearing here, Craig, is not much has changed in the mortgage space today. There's data is still fragmented based on all these different tech stacks, and that's what's putting organizations at risk. One, two,
Right.
it's creating inferior data, and it's creating a inferior customer service experience. And that's creating some. So not much has changed, but just looks newer and feels cleaner and a couple more features and functions.
Yeah, I mean, not as much as as you think it would have changed over that period of time. I mean, you think about it back then, as we just were talking a couple minutes ago, back in those days, we didn't have an iPhone.
Yeah.
You didn't have one. So phones, devices went from just a telephone to what you have today in that time frame. But yet we still can't get away from integration code between a best of breed, quote, sales system that's trying to talk to an origination system, or an origination system trying to talk to a servicing system, or just a servicing system trying to get up into where the technology is in this century.
So I think this is a perfect time to bring Lester your thoughts into this conversation about, where we've been and how would you describe the mortgage technology space today, building on Craig's perspective.
I think every customer will agree with this. It's gotten expensive. When we do design work, I always try to start top down. What's the result I'm trying to get to? And then I start filling out below it how I get there. And if you look at, I remember when the first time we had $5,000 per loan to originate, that was kind of a milestone with going, wow, that's really expensive. How do we get there? And now, the 13 to 15,000, whatever the number is, we're doing the same thing. The quality is better, but why does it cost so much more? And I think that's one of the things we're working on fairly diligently, of ways we can come up with ideas and integrations, or lack of integrations when it's all part of the same platform. How do we reduce that cost? And you look at the companies, this has kind of gone back and forth through different times and volumes of business. But we went from a period of time where everybody did toolkits, built their own systems, had massive IT staffs. Then 2008-9 hit, the IT staffs were gone. So then we flipped to, I got to have something out of the box, and then some hybrids of that. But every time we do these, what we think are improvements, there's a cost that comes with it. And I'm not sure from the lender perspective, a lot of these costs are really justified. Let me just do a real simple example.
Yeah.
If I've got a verification of employment and I've got staff that's not real busy because volumes are down, can I pick up the phone and verify employment? do I have to spend $12, $15 with a service to do it? That adds to my cost. So I think you have to look at every single incremental cost and look at the circumstances. And it's not like a single solution fits all the time. It's always going to change with your volumes. It's going to change with your personnel staff. It might be you make that a training exercise to bring processors up to speed. And that's just one little simple example. But if you take that across the whole process, where have we added cost that really don't have the benefits that the cost does? And I think that's how you go from 5,000 to 13,000. Obviously, there's other pieces in there. But the other thing I think we've seen, and we probably haven't seen as much with our customer base, but I think John can attest to this when he goes through the sales process. One key number we like to look for is how many loans did you close per user? And let's take that a little step further. How many licenses are you paying for your origination system, and how many loans? And one fairly large company that used to publish that number when they were public, that number every year went down. So their customers were getting less productive. And it got down to the point it was barely over one. So that means for every seat license, you were closing one loan. And so we saw that number, and our client base came out, I think, a little over 3 to 3.5. And we still thought that was low. But one is, I don't see how you can stay in business long doing that.
Yeah.
So those are the kind of like just rule of thumb numbers you can look at. Like every industry has rule of thumb numbers. That one just glaringly stands out. So anybody that looks at their license count, number of employees, number of loans closed, I think you can look at your health real quick to see where you're at there.
Yeah.
But from a technology standpoint, sure, we have to do more. Fannie, Freddie, CFPB, they've always a lot more compliance. That costs money. The GSEs have pushed more of the work down on the lenders, and then they push it down to the software vendors. So that raises everybody's cost along the way. But to almost triple in less than 20 years, I'm not sure all that's justified. And that's where guys like you, Keith, you have to come in and help figure that out for each customer, because every one of them are different. But from our perspective, we're doing some things that I think are helpful. As an example, now with loan volumes down, on the LOS side and servicing, we charge based on the transactions, not seats. So if you went from closing 1,000 loans a month to 100, in our case, your bill's going to be 10% of what it was before. In some cases, you're still paying the full load back to when times were great. You're doing 1,000 loans per month. And I think that's unfair. Certainly, my cost of hosting somebody at 1,000 loans per month versus 100 is lower. And the customer should be getting that benefit. It all shouldn't be one-sided on the vendor. And the same thing goes with these long-term contracts. You sign a long-term contract, it's all in the favor of the vendor. You think you might be getting a price break, but in reality, if you negotiate and look at the competition, you're probably not. But you're locking yourself into a technology that might not be what you want next year, 2 years, or especially 5 or 7 years. And some vendors are harder than others to get out of contract. So we make that easy. You can cancel anytime. Sorry, we've done something to lose your business, but we don't think we should lock you in to something that's not good for you. That doesn't build good long-term customer relationships.
All of that resonates with me on so many fronts, Lester. Especially there at the last point there, I've heard firsthand with prospects and clients, you know what, we're going back to MortgageFlex. And I heard when I was at Acuma last week, and John and I bumped against each other in the hallways, I had heard a couple companies that said, I just can't get out of my long-term contract with my point of sale, and I'm screwed. And they just, I mean, I think you're right that there's a lot of these organizations, it's very one-sided, the opportunity in the relationship, and that's why I've always respected your approach. But the other part that really strikes a chord with me, and that I agree with you 100% on, is the cost per loan per employee. And people keep asking our team, how do I lower production costs? Now, the funny thing is, or not funny thing is, in this industry, when times are good, people don't care because they're just going to pass the cost on to the consumer. It's just part of your closing fee, whatever that per loan cost is. We find that particularly with the IMBs who are just kind of coming in, ride the wave, and then get out when the mortgage market crashes again. But then you have the credit unions and community banks where they really care about their member, their customer, and they want to actually effectively lower their cost to produce and cost per loan. And we keep having to tell them that you got to focus on your per employee productivity, because if you work out the efficiencies in that drives that number up, you'll drive down your cost to produce by well over $500,000 a year. We have the numbers and the analytics to prove it, and we even published a paper on it. So I'm in complete agreement with you there that, while the mortgage technology space today has matured with newer cutting edge, we have a subsequent problem, and that is that we keep buying the new shiny object as opposed to, and then just paying whatever the fee is because times are good, as opposed to really underwriting it to say, do I really need that? And is it really an effective use of our dollars? And who pays ultimately, again, is the consumer. And that's where I really struggle with that concept that we allow costs to get out of control because we're not looking at our business closely enough. And two, we just feel like, it'll be absorbed by the consumer. And I don't think that's fair when they could use that cost savings to get better rates, right? I mean, it all ties in together. So sorry to get on my little tirade there, but I agree with you 100%. And that's what I've liked about your approach all along. So, well, let me try. Any other points on the mortgage technology space today that you guys want to highlight? That's just general issues in the space, or should I go ahead and move on?
Well, just one last comment on that.
Yeah.
There's some technology that's so old, I think it's getting to be a risk. And let's look at servicing. I mean, it's not so much in the origination side, but certainly in servicing. They've got a couple major platforms that have the bulk of the loan service in the U.S. and one's 59 years old, the other one's probably around 50. Built on 1960s COBOL technology, and you'd have to explain to programmers what batch processing is because they haven't taught that in college in a long time. So if you look at that from a risk standpoint, or if something breaks, how do you fix it? Or how does it keep going? Now, there's other industries like insurance, and I'd say even a little bit of healthcare that have systems that old. But I just see there's just an institutional risk of running technologies that old. And especially if you've been paying that bill for 30, 40, 50 years, and that money's going somewhere and not to rewriting the system, bringing it up to a current technology, don't go sign a 10-year contract for it again.
Yeah. Well said. Great advice. Great advice there. John, Craig, anything else to add before we move on? All good?
I mean, yeah, to your original point of how does somebody make sense of all of it. Obviously, as we're in a highly regulated business, we all have to do effectively the same things. You get more creative on the sales side. From a point of sale standpoint, whether or not you're using, what your point of sale system is, what your CRMs are. So there's a lot of variability you have there. But once you've got that threshold as an application, now you're into a kind of a well-regulated process. And to the point before about cost, it's how can I get through that well-regulated process at the lowest cost possible? And it's impossible because the shiny new system that gets announced every year just adds a bit of a price tag to the overall cost. And people say, hey, I have to have the new thing. But to the point Lester was making, is it really something that you need to satisfy the requirements, whether it's the GSEs, whether it's the FHA? Do I really need to spend that money? And is it really going to make the loan less risky or make me more profitable? And those are hard questions, and people don't ask them. They just want the new neat stuff.
Yeah, I have some other belief systems behind some of those challenges in the decision-making process, but I'll save that for another day. But I think you guys are spot on when it comes to, really having to take a hard look at your costs and being honest with yourself about, why are you buying this and what's the lift? Have you really done a cost benefit analysis for your organization? I get those calls frequently, people saying, hey, can you do cost benefit analysis of buying a new tech for this particular place, whether it's servicing or origination or point of sale, et cetera, CRM. So, I am glad that we get that call on the occasion, but I don't know that enough people are thinking in that multi-dimensional, sphere. So, great words of wisdom. John, anything else to add, or all good?
Good.
Okay, so and that's all good. We did cover a lot of ground with that first question. So let me transition to asking you. So with those descriptions or those definitions of kind of the current state of mortgage technology in mind, then what do you guys believe lies ahead for mortgage lenders as it relates to these challenges or other obstacles that they're hitting? So if they stay on the current road they're on with the tech stack strategy that they have today, where it's multi-level, tech stacks and incongruent systems, not necessarily integrated, etc. I mean, guys, there are a lot of great technologies and tech stacks out there, but are there risks or inefficiencies or other specific gotchas buried in the middle of those at lenders and servicers that they might be blind to today? Do you have any stories or use case scenarios that you can mention to help kind of further educate us on really rethinking what the tech stack trend of today is?
Well, I'll kind of start with that because this is what I've been working on the last 2 years. When you buy a system and you negotiate your contract, you got your cost down, but you don't know all your costs until you've been running it for a while. It's not just what you're paying the vendors, it's what it costs you to support it. And one of the things that we'll be coming out with first quarter next year is we've decided to merge the LOS technology with the servicing technology. So we're actually putting the database model for both applications into a single database. So from a tech standpoint, when you look at people's costs, and the mortgage industry has always been very siloed between origination and servicing. And in any medium to large size organization, most of the times they're not even in the same city. They're usually very separate. So we're kind of more targeted at mid-market that's more likely to operate or try to operate as one unit rather than two separate siloed units. So some of the extra costs you have when you have disparate systems is you've got a different tech stack. You've got, if you're doing a lot of in-house work, you've got DBAs for each application. You've got programmers with different skill sets for each application. You got different tool sets. You might have different reporting tools. You might have a different way to work data warehouse for each one. So when we looked at this 2 years ago and said, that doesn't make sense. That's where a lot of your costs that are somewhat hidden in the beginning, but get exposed over time when you actually operate, that we can eliminate that by putting the whole system into one stack, one set of tools. So if I'm running a report for servicing, I'm using the same tool to run a report for origination. If I'm designing one, I'm using the same design tools. If I'm using the workflow application, I can design workflows that cross over between an origination function and a servicing function and back if I refi or I have to go through some remediation program on a default. So it works as one big symbiotic system rather than disparate systems. So that's one way you could dramatically cut your costs by your labor pool in terms of supporting that application, which in the beginning is the hidden cost. You can reduce that greatly. But the other big advantage in a time like today is, you've got people laying off people in originations, now trying to hire people for default. So if you're in one system, same user interface, same tools, skill sets on how to use the system require minimal training, you can move somebody that was originating or processing loans over to handling defaults and potentially foreclosures with less training than bringing somebody in off the street that, last time they did this was 2009, 2010. Yeah. And so there's always a shift between workloads between servicing and origination as the economy goes up or goes down, real estate goes up, goes down. So if I can smooth that curve out, and you got a lot of great employees that you really don't want to lay them off. You've got other uses.
Reallocation. That's what I've always called it. I completely agree. And you can more seamlessly do that, and you reduce the turn, the onboarding time, right? Because they're already acclimated to the system. That's a really good point, Lester.
Yeah, I mean, this if you look at the deposit size of the banking industry, they've always done it. And that was kind of, when I looked at this, that was kind of the model I was looking at. But in the lending side, you might see a little bit of it in the consumer lending side, but I've never seen it in mortgage. So our approach is it really needs to be one platform, not two platforms. It needs to be in the same tech stack. It needs to be the same support people, and you need to give your employees the opportunity to move around depending on what job fits best. You might take a great processor and they go over to servicing work defaults. They're even better at that. So you can get some great results just from not going out having to hire staff when they're sitting right in front of you, just doing a different job function. And it gives them some upward mobility to keep your best people so they'll leave by giving them new challenges.
That's a great advice and great wisdom as it relates to, additional challenges within this industry and what's a kind of a hidden obstacle or a hidden issue lying in the inefficiency that's lying in the middle of these disparate systems between origination and servicing. And so the part of the obstacle I hear you saying is we need a paradigm shift in our industry. We need to get away from doing things the way we're doing them now, because they are costing us $14,000 per loan is the latest number I heard to close that loan. And so you're going to have to migrate to a new paradigm. You're going to have to migrate to a more, seamless system between the two in order to really maximize the great assets, human assets, as well as efficiencies on all sides of the industry. So I connected the dots on that very clearly. I think I did, but as I listened to you, Dominic, so I think those are really good insights in what new ways that people need to be thinking in the industry. Craig, John, additional thoughts on this point?
Yeah, to add to what Lester said, I think lenders are really starting to see the value of servicing. And I've talked to so many this year that I think have regrets that they don't have it in-house. And whether it's at a sub-servicer or whether they've been selling those loans off, I see a scramble to get back into the space. And a lot of those folks need a lot of education around how to do it, what to look for, what technologies are out there. And, we want to give them an easy avenue to step into the most modern product in the space, and with a great customer experience that has 25 languages available for their customers, and they can easily hop into a product that they can grow with. And there's a lot of folks in the industry that I think are going to be moving into the servicing. They realize the value during the downturn, and that is keeping a lot of IMBs alive as they sell these MSRs off. And the ones that don't have it are the ones that are in trouble. And I think there's going to be a lot more folks that are that bringing that back in house if they're sub-servicing or starting to service for the first time. And the customer experience. when you're working so hard to originate these clients, and then you're basically turning the relationship over to a different company. And in many cases that the customer experience is not what you'd want for your clients. And that's a reflection upon yourself as a lender. And you want those folks to come back. You want them to be customers for life, not customers for 30 days. And then by losing that relationship, you sort of lose those touch points, and you really want them under your own roof so that you can really take care of them, cater them, and promote new products to them, and hopefully that they're going to bring repeat business and referrals.
That's a really good point, John. I mean, you're really challenging organizations to start thinking more three-dimensionally as opposed to just the loan transaction, right? Very one-dimensional. Let's just get through this loan and get it closed. And in order to be successful in tomorrow's mortgage market, people again need to go through a paradigm shift of, instead of just looking at the transaction, look at the life of the loan and the life of the relationship and the other opportunities you might be able to help them with. And servicing, there's some nuances there, but I think what I'm also hearing you say is one of the challenges and obstacles to today's current tech stack and mentality and mortgages, because they're not opening their mind to the potentiality of servicing, they're really limiting their capability, limiting their opportunity in the future. This mortgage market's going to be tough. I mean, even still compared to the last couple of years, it's still going to be tough for the next 12, 18 months. So they need to start looking at their business differently, is what I'm hearing you say, John. Did I summarize that okay?
You did. And I think the other thing is be open-minded to different products. Our system supports a lot of different products that other platforms don't. So consumer lending, chattel lending. I saw that New Res started offering pool lending this month. So lenders are really thinking outside the box. What else can I do? Can I do solar? So we can offer all those type of consumer lending capabilities, both on the origination and servicing side. And you've got to be able to offer different product mixes to your clients today instead of just looking at a standard conventional loan.
Yeah, and that's why your phone's ringing today. Craig, other thoughts on this point?
Well, I mean, again, it all ties in together. I mean, we all work here for a reason, and we all kind of line up. We all have the same kind of perspective on this. But a lot of times, what John runs into, and we see it in people's shops in terms of their ability to be efficient and produce loans efficiently. But there's a sense of people don't really respect differentiation as much as they used to. The latest guy comes out with the latest little widget and everybody lines up to buy it. Well, how are you going to differentiate yourself? Make yourself different, potentially better, if you're lining up with the same technology stack as the guy down the street or your nearest possible competitor. You're limited on the technology you can deliver because you all have the same vendor. You're limited in terms of your cost wise, unless you got a better contract than the next guy, which odds are you don't. So how do you improve your business? How do you improve your ability to deliver loans to your customers? If you're all lining up to do the same thing, you all end up like lemmings, all kind of want to do the same thing. And to John's point of open your mind to other systems, I think it's not just opening up your mind, but it's also looking at the opportunities, financial and operational, of using different systems. We've had a lot of really great conversations with people about servicing, because obviously it's the newest significant product that we've introduced, and we've gotten a lot of great responses. But people need to take.
You're filling a hole in that space. It's been void for a long time.
Right. And you're still having a lot of challenges though, where people don't want to, they're in a comfortable spot, and they don't necessarily want to, they have to start looking at instead of looking at what's the risk, let's look at the opportunity. And that's all part of the differentiation. I'm going to make myself different from the next guy down the street. And what does that get me? Where's the opportunity? How does that opportunity show up? How can I deliver product better? How can I have a better relationship with my client? And it's, again, differentiation is not just servicing, but it's also on the origination side as well. But you have to do it smart. You can't just be buying the latest gizmo because you think it'll reduce your risk. You have to do your homework, you have to do due diligence on these things because they all have costs associated with them. You know, for the past 10, 12 years, all you've heard every year, you know, by the primary providers out there about, hey, we're doing this and it's going to reduce the cost to do a loan by X dollars. But yet every year it's your cost to originate is inching up. It's, you know, 15%, 10%, 50, you know, and so that number keeps getting bigger and bigger and bigger, but they keep promoting the fact that you're saving money. Those two things don't coexist. So you have to really look at the opportunity how do I differentiate? How do I get out of that rut of that where everybody else is and establish myself as being somebody who's different, who can do things better? And a lot of that comes down to you just have to look at it from the perspective is how can I use this to be a better provider, to be more efficient, instead of always looking at what's the risk.
That's tremendous. I love the exclamation point you just put on the whole conversation right there. So when I boil this down, when I really boil all this down and make sure I get this correctly, is part of what I'm hearing that the tech stack strategy is dead? Is it dead because it's too high of risk, too high of cost? You're buying a technology that may be a shiny new thing, but at the end of the day, considering the fact that 75% of all implementations fail, and it's not necessarily because of technology, because of people, the lack of strategy, the lack of internal communications, change management, the lack of project and program management, all those moving factors, just the risk is way too high, and the cost and the siloed data structures. You're just, at the end of the day, is that what I'm hearing? Is that the traditional tech stack strategy over the last 10, 15 years is dead?
I don't know, Lester. I wouldn't say
I wouldn't call
it's
it
that.
I think there's a difference between the tech stack and the technology itself. If an example, with their new LOS system coming out in January, it's the same database on the existing stack. We just rewrote the middle tier and the front end in a newer technology. So if you're doing the right things and your system makes the users productive and they've got good cost controls in place, the technology you're using shouldn't matter. But the reality is, if your vendor doesn't keep pace with technology, stuff gets old and unsupportable. So if I told you I have a brand new LOS system written in COBOL that batch processes at night, one, you wouldn't know what I'm talking about, but if you did, you probably wouldn't be interested, or you shouldn't be interested. So the thing we've always done, and I think this number is not exactly like Moore's law or processors, it's probably about every 8 to 10 years, 12 years, that the technology stack changed significantly. Like if you go back, let's start way back, COBOL. Then we went to some microcomputer systems and then mini computer systems that use languages like RPG and BASIC and things like that. Then we went to Windows, and now we've gone to web, and now we're going to the second generation of web. So I think as long as your vendor isn't one generation behind in their tech stack, you're probably fine from a risk standpoint because it won't become obsolete. But if your vendor's 5, 6, 7 tech stacks behind, they're probably never going to catch up, because to do that's almost impossible. But the investment to do it would probably scare them away from doing it. And then you compound that. If you sign a long-term contract with them, you've encouraged them not to upgrade their tech stack.
Yeah.
So it's not really the tech stack itself, it's the not getting behind. Because I can't tell you a user on our Windows system or .NET system or the new web system doing that same function, that same screen. That's what made them more productive. What made them more productive is a better design, effectively using workflow. As we get to AI being more reliable and lean on it, it won't matter what the underlying technology is unless you can't integrate it because it's so old that you can't integrate with the newer technology. So it's more about don't get too far behind, no matter what you're using.
That's fair. No, I appreciate your resizing that comment. It'd be more appropriate as people take a look at their technology, particularly here at the end of the year, and then starting to do some planning and budgeting for 2024. I think that's a really critical perspective that people need to be relooking at their technology with. Craig, John, how else would you boil this down? I mean, obviously the impetus of MortgageFlex One Vision, the one technology stack and one database, I mean, that you guys have been kind of hinting at here. I mean, that came from a vision of where you're seeing some of these breakdowns in old technology and siloed technology. So can you give me a little more perspective, or our listeners a little more perspective on where you're coming from with that infrastructure and that approach?
From the folks that I talk to in this space, nobody loves to have a servicing system, and that's been the challenge. And when I bring up the fact that we are offering both on the same technology stack, more times when I start off on just an origination path with them, we're all of a sudden jumping into servicing and taking a look at that. And I just think lenders are enthused when they see I can actually get two platforms that look the same from one vendor, and I can have true portfolio protection because my borrowers can actually originate themselves and save me a lot of money on the origination side because it's the same data structure. The portals interact back and forth. So I just see a lot of surprise that something like that is available, and I'm still just frankly shocked by how many mid-sized and small-sized depositories that I talk to that are manually keying in data into a servicing platform. And it's just so much inefficiency, so much staff, FTE count that are doing that manual efforts, whether it's manual escrow, manual entry. It just really is an underserved market, and we're just hopeful that we can continue to get people to realize that there's a better way, and one that won't be abusive to you in regards to cost. And we're not charging for data, for example, like we see on both the origination and the servicing sides. And it's a better, more modern model that we're offering.
That's critical. Great viewpoint. I like the way you summarized that. Craig, anything more to add on that as far as kind of the move forward of to be successful in this industry, and how you need to be thinking about your origination and servicing technology? What are the philosophies that have you summarized that really help accentuate why you did the MortgageFlex One Vision, one technology, one database, and the benefits from that?
Well, so there's a couple things. The whole technology component, and we're in that business. We're big believers in it. We're big believers that with the right technology deployed the right way, you can be very efficient at what you're doing. We try to treat customers with contracts that encourage them to do business and don't penalize them unnecessarily. Obviously, we're all in this to make money. They are, we are, we're all trying to do the same thing.
We're not running charities here, right?
No. There's no charities here. But at the same token, we want people to be successful, because if they're successful, we'll be successful. So the whole technology, it really comes down to people doing their due diligence, being a little bold. We're big believers in a lot of industry initiatives. MISMO particular, initially we thought MISMO was, they tried to commoditize a lot of services, and people didn't want to be commoditized, and we understand that. I wouldn't want to be commoditized either. But at the same token, so people need to differentiate. We've already kind of established that you can't be doing the exact same thing as your guy next door, because then you're limiting yourself on how do you differentiate on price, and service. And sometimes, if you're in the same geographic area, service is tough because you're dealing from the same pool of resources. But that being said, the technology, we're big believers. You have the proper utilization of technology, and don't just line up because that's the popular option. If the popular option was 50 years old, is that something, I want to buy a new water heater for my house. Oh, let's buy the 50-year-old technology one. How's that working? And I use this phrase all the time, and everybody hates it, but cars in Cuba. I mean, they're all driving old cars in Cuba, and yes, they'll get you from here to there. But really, so let's realistically look at what can a 50-year-old technology, a system based on 50-year-old technology really get me to the places where I need to be, or do I need to look at something that's brand new? People line up around the block to buy a new iPhone. That's just one generation different from the one before. But yet on the servicing system, that they may have 10, 15, 20,000 loans in a relationship with the consumer that's based on all that. And they just ignore that, the lack of functionality, the lack of capability in some of those. And again, not to be banging on them, but that's just the reality of the situation we're dealing with here.
Yeah. And the opportunity.
Yes. And so you have to look, what's consumer patterns, and how do people shop, and how do they understand how is this going to differentiate me, make me better, and how do I serve my customer better? So the investments in technology are necessary, but it's looking at it from a different perspective. Just don't buy it because the other guy down the street's buying it. Just don't buy I may be on their core banking system, so I need to get their loan origination platform. And you have to look at it for what benefits are going to bring to me and my customers, and my employees, frankly. It's not just customers. It's how do I retain the best staff? How do I utilize the technology to get better underwriting? How do I get better integrations with third-party services? How do I make all those things happen and without being taken advantage of by my vendor?
Yeah, that's good.
And so just my perspective.
No, that's absolutely fantastic, Craig. I appreciate your rolling it up to those fine points. Dominic, any final comments before I kind of start to close up the conversation here? Do you guys have any other words of wisdom that have come to mind here in the last couple minutes, and want to make sure that you get in with our listeners?
Well, I think Craig's point of differentiation is really important. As software vendors, we try to differentiate ourselves, and that gives us advantages in the market if we're successful at that, as long as the differences are good. But same thing with lenders. If you're just like almost like another branch of the same lender down the street, if you're doing everything with the same tools and the same people, same thing. So how do you expect a better result? You're not going to get it.
I agree. Well said. All right. Any other closing comments?
I would add that if I would describe the last 18 months to 2 years in the LOS and servicing and PPE, CRM, POS space, I would say a lot of bad behavior. And it was some of the larger vendors that were going through acquisitions or potential acquisitions that were holding customers hostage on either side, whether it was over optimal blue or it was over servicing with the Black Knight MSP platform. There was just a lot of bad behavior. So all those systems now semi-separated, and now there's going to be more bad behavior because somebody's got to pay for these costs of these acquisitions, and you're talking over $20 billion combined with the two purchases, and there's going to be a lot of that's going to be on the burden of the lender's back, unfortunately. So I think you're going to see some folks that are going to want better partners, and that's where we come in.
I love that. And that really resonates with me as well, John, because I've gotten the calls. People are saying, you know what? My costs are going up at one of the worst times. in lending, and I can't afford my per loan cost to be going up. So I think you're spot on when it comes to, what the acquisitions are boiling down to, and it's no different than, a lender saying, well, my cost went up, so I got to pass it on to the consumer. So through the acquisition, their operating costs had to go up. They needed to squeeze out more revenue from their new company, so let's raise the cost, and they'll just pass it on to the consumer. I mean, the consumer is in a lose-lose here. So firms really do. I think you've all summarized this extremely well. That one, firms need to have a paradigm shift. They need to be really looking at their technology costs. They need to be looking at their infrastructure. Is it aged? How can I reduce my costs? How can I reduce my my risks through data and making sure that it's not stagnant or siloed in different components of my organization. Organizations need to be thinking more thoughtfully around how they're going to do business. They need to make sure they have a platform that's agile and allows them to expand their product line easily without having to add 3 more technologies to their overall stack. So I just think this was an invaluable conversation, and gentlemen, I really want to thank you. Powerful discussion, and just a ton of great thought leadership here packed into this short little conversations for lenders and services to really ruminate on as they envision their technology and business path forward. So they can more, effectively optimize mortgage lending and technology and lower their costs and risks. So I want to thank you. I really am grateful for the time. I'm excited about where we landed with this conversation. I'm already thinking about maybe a follow-up conversation that we can have to build on some of these concepts and give people very, very descriptive, prescriptive recommendations on move forward strategies. So thank you all. Appreciate you being on the call today.
Thank you, Keith.
Thanks, Keith. Thanks for
Yeah.
having
Our
us.
pleasure. Yeah.
Absolutely. Folks, you heard it here. It's time to rethink mortgage technology. Nobody knows better than a team that's been revolutionizing mortgage technology for over 40 years. To learn more about our preferred partner, MortgageFlex, you can check out their website by going to MortgageFlex, that's one word, .com. Until next time, this has been another great and exciting episode in the Shark Cage. Thanks so much for being here. Have a good day.
Thank you for joining us in the Shark Cage. To be a guest on a future episode, send an email to info@blackfin-group.com. To find out more about the show or the information provided in this episode, visit BlackFin Group online at www.blackfin-group.com.